Question 1. Research into a broker-dealer's compliance with FINRA Rule 6000 series. A principal is evaluating the firm's market regulation program. Which of the following approaches best demonstrates a commitment to ensuring the firm's adherence to these rules? Option A. Accepting the firm's written assurance that all trading activities are conducted in full compliance with FINRA regulations. Option B. Reviewing the firm's written supervisory procedures related to market regulation, examining trade blotters for suspicious patterns, and interviewing compliance and trading staff about their understanding and application of these procedures. Option C. Assigning the entire review of market regulation compliance to a junior compliance analyst without further oversight. Option D. Conducting a random review of a small percentage of executed trades without examining the firm's supervisory policies or interviewing staff. The correct answer is B. Reviewing the firm's written supervisory procedures related to market regulation, examining trade blotters for suspicious patterns, and interviewing compliance and trading staff about their understanding and application of these procedures. Explanation. This scenario is professionally challenging because it requires a principal to evaluate the effectiveness of a firm's internal controls designed to comply with FINRA Rule 6000 series, specifically concerning market regulation. The principal must not only understand the rules, but also assess how they are implemented and monitored in practice, identifying potential gaps or weaknesses that could lead to violations. Careful judgment is required to distinguish between minor procedural oversights and significant compliance failures. The correct approach involves a comprehensive review of the firm's written supervisory procedures, WSP, related to market regulation, examining trade blotters for unusual activity, and interviewing key personnel responsible for compliance and trading. This approach is correct because it directly addresses the core requirements of FINRA Rule 6000 series by verifying that the firm has established, documented, and is actively enforcing policies and procedures designed to prevent manipulative and fraudulent trading practices. It also involves a practical assessment of how these procedures are being executed and supervised, which is crucial for a principal's oversight responsibilities. An incorrect approach would be to solely rely on the firm's self-attestation that all trading is compliant without independent verification. This fails to meet the principal's supervisory duty to ensure compliance, as self-attestation alone does not provide assurance that rules are being followed or that supervisory procedures are effective. Another incorrect approach would be to focus only on reviewing a sample of trades without examining the underlying supervisory procedures or interviewing personnel. While trade review is important, it is insufficient if the firm lacks robust WSPs or if personnel are not adequately trained or supervised in their application. This approach misses the systemic aspects of compliance. A further incorrect approach would be to delegate the entire review process to a junior compliance officer without providing specific guidance or conducting a follow-up review of their findings. While delegation is a tool, a principal remains ultimately responsible for the adequacy of supervision and compliance. This approach abdicates the principal's direct responsibility. The professional reasoning process for similar situations should involve 1. Understanding the specific regulatory requirements, e.g., FINRA Rule 6000 series. 2. Evaluating the firm's existing WSPs for adequacy and alignment with regulations. 3. Implementing a multifaceted review process that includes documentation review, data analysis, e.g., trade blotters, and personnel interviews. 4. Assessing the effectiveness of supervisory controls and identifying any deficiencies. 5. Taking appropriate corrective actions to address any identified compliance gaps. Question 2. Compliance review shows that your firm is preparing to offer a new private placement security to clients in multiple states. The issuer has provided documentation indicating the security is exempt from federal registration under Regulation D. Your firm is registered as a broker-dealer with FINRA and has agents registered in all states where the firm conducts business. What is the principal's primary responsibility regarding state securities law compliance for this offering? Option A. Verify that the security is registered or exempt from registration in each state where it will be offered to clients, and ensure the firm and its agents are properly registered to conduct business in those states. Option B. Proceed with the offering in all states, assuming that federal registration exemptions automatically grant exemption from state registration. Option C. Contact the issuer to confirm their understanding of state registration requirements, but do not independently verify the registration status of the security in each state. Option D. Rely on the issuer's representation that the security is exempt from federal registration, assuming this automatically satisfies state registration requirements. Correct answer is A. Verify that the security is registered or exempt from registration in each state where it will be offered to clients, and ensure the firm and its agents are properly registered to conduct business in those states. Explanation. This scenario presents a common challenge for a general securities principle, ensuring compliance with state-level securities registration requirements, often referred to as blue sky laws, while facilitating business operations. The principle must navigate the complexities of multiple state regulations, as each state has its own rules regarding the registration of securities and the persons or entities that sell them. Failure to comply can result in significant penalties, including fines, disgorgement of profits, and reputational damage. The challenge lies in accurately identifying which securities require registration in which states, and ensuring that the broker-dealer and its agent are properly registered to conduct business in those states. The correct approach involves a thorough understanding of the Uniform Securities Act and its adoption by individual states, or any specific state statutes that deviate from it. This includes recognizing exemptions from registration for both securities and broker-dealers, and understanding the filing requirements for non-exempt offerings. A principal must proactively research and maintain knowledge of the registration status of all securities offered by the firm, and the registration status of the firm and its representatives in every state where business is conducted. This proactive stance minimizes the risk of inadvertent violations. An incorrect approach would be to assume that a security registered in one state is automatically registered in all states. This ignores the fundamental principle of blue sky laws, which are state-specific. Another incorrect approach is to rely solely on the issuer's representations about registration status without independent verification. While issuers are responsible for their own filings, the broker-dealer and its principal have a supervisory duty to ensure compliance. Furthermore, assuming that a federal registration automatically exempts a security from state registration is a critical error, as federal preemption is limited. The professional decision-making process for such situation should begin with identifying the scope of the firm's business activities, including the states in which it operates and the types of securities it intends to offer. Next, the principal must consult the relevant state securities laws for each of those states to determine registration requirements for both the securities and the firm's personnel. This involves researching exemptions and filing procedures. Finally, the principal must implement internal controls and procedures to ensure ongoing compliance, and to periodically review and update this information as regulations or business activities change. Question 3. Comparative studies suggest that effective implementation and enforcement of firm policies and procedures are critical for maintaining regulatory compliance and mitigating risk. A general securities principle is reviewing the firm's current approach to ensuring registered representatives adhere to the firm's insider trading policy. Which of the following represents the most effective strategy for implementing and enforcing this policy? Option A. Develop a comprehensive policy that is communicated to all registered representatives, followed by regular, targeted surveillance of trading activity and communication records, with a clear escalation and disciplinary process for identified breaches. Option B. Implement the insider trading policy through a one-time onboarding training for new hires and address any issues only if they are flagged during a regulatory audit. Option C. Conduct an annual firm-wide training session on the insider trading policy and rely on registered representatives to self-report any potential violations. Option D. Focus enforcement efforts primarily on registered representatives who have previously received customer complaints, assuming others are compliant. The correct answer is C. Conduct an annual firm-wide training session on the insider trading policy and rely on registered representatives to self-report any potential violations. Explanation. Scenario analysis. This scenario presents a common challenge for general securities principles, ensuring that firm policies and procedures, designed to comply with FINRA regulations, are not only documented but actively and effectively implemented and enforced. The challenge lies in moving beyond mere compliance on paper to a culture of adherence and risk mitigation. A principal must balance the need for robust oversight with the practical realities of managing a sales force, ensuring that enforcement is fair, consistent, and addresses potential misconduct proactively. The risk of inadequate implementation or enforcement can lead to regulatory violations, reputational damage, and financial penalties. Correct approach analysis. The correct approach involves a proactive, risk-based strategy for implementing and enforcing firm policies. This means regularly assessing the firm's operations and identifying areas with the highest potential for compliance breaches. It requires developing clear communication channels to ensure all registered representatives understand the policies and the rationale behind them. Crucially, it necessitates establishing a system for ongoing monitoring, testing, and auditing of adherence to these policies, coupled with a consistent and fair disciplinary process for violations. This approach aligns with FINRA Rule 3110, Supervision, and the general principles of effective compliance management, emphasizing a commitment to preventing and detecting misconduct. Incorrect approaches analysis. Implementing policies solely through annual training without ongoing reinforcement or testing fails to address the dynamic nature of the securities industry and the potential for policies to become outdated or ignored. This approach is insufficient for effective supervision and risks regulatory violations due to a lack of continuous oversight. Enforcing policies only when customer complaints arise or regulatory examinations occur represents a reactive rather than a proactive stance. This approach allows potential misconduct to persist undetected, increasing the likelihood of significant violations and penalties. It demonstrates a failure to implement a robust supervisory system as required by FINRA rules. Focusing enforcement efforts exclusively on the most senior or highest producing registered representatives, while potentially addressing high-profile issues, creates an uneven and potentially discriminatory enforcement environment. This selective enforcement can lead to perceptions of unfairness and may allow misconduct among other representatives to go unaddressed, undermining the overall integrity of the firm's compliance program. Professional reasoning. General Securities principals must adopt a comprehensive and systematic approach to policy implementation and enforcement. This involves understanding the firm's business, identifying key risks, developing clear and accessible policies, communicating them effectively, and establishing robust monitoring and testing mechanisms. When violations occur, a consistent and fair disciplinary process must be applied. This proactive risk mitigation strategy is essential for fulfilling supervisory responsibilities under FINRA regulations and fostering an ethical business environment. Question 4. System analysis indicates that a general securities principal is responsible for overseeing the activities of several registered representatives. The principal notices a recent increase in the number of minor customer complaints directed at one particular representative, alongside a slight uptick in the representative's trading volume in a few client accounts. The principal is aware that this representative generally has a good compliance record. What is the most appropriate supervisory action for the principal to take? Option A. Rely on the representative's assurance that they are handling client matters appropriately and that the increased activity is due to new client onboarding. Option B. Advise the representative to be more careful in their client interactions and assume the increase in complaints and trading is a temporary fluctuation. Option C. Wait for a significant customer complaint or a formal audit finding before initiating a detailed review of the representative's activities. Option D. Conduct a thorough review of the representative's recent customer complaints and trading activity, looking for any patterns or anomalies that may indicate a violation of FINRA rules. The correct answer is D. Conduct a thorough review of the representative's recent customer complaints and trading activity, looking for any patterns or anomalies that may indicate a violation of FINRA rules. Explanation. This scenario presents a common challenge for a general securities principal, balancing the need for efficient supervision with the absolute requirement to ensure compliance with FINRA rules regarding registered representative activities. The principal must act proactively to identify potential red flags and conduct thorough reviews, rather than passively waiting for issues to surface. The challenge lies in discerning when a representative's activity, even if seemingly minor or isolated, warrants deeper investigation to prevent potential violations of suitability, best execution, or other conduct rules. The correct approach involves a principal diligently reviewing a registered representative's customer complaints and trading activity for any patterns or anomalies that could indicate a violation of FINRA rules. This proactive and thorough review aligns with the principal's supervisory responsibilities under FINRA Rule 3010, which mandates that member firms establish and maintain a supervisory system reasonably designed to achieve compliance with applicable securities laws and regulations. Specifically, reviewing customer complaints and trading patterns is a fundamental aspect of identifying potential suitability issues, unauthorized trading, or excessive trading, churning. This approach demonstrates a commitment to safeguarding customer interests and upholding the integrity of the securities markets, which are core ethical and regulatory obligations. An incorrect approach would be to dismiss a pattern of customer complaints as isolated incidents without further investigation. This fails to recognize that multiple complaints, even if seemingly minor individually, can collectively signal a systemic issue with the representative's conduct or understanding of client needs, potentially violating suitability rules. Another incorrect approach is to only review trading activity when a specific customer complaint is filed. This reactive stance is insufficient. Principals have a duty to proactively monitor trading activity for red flags such as high turnover rates, in-and-out trading, or concentration in speculative securities, which could indicate churning or unsuitable recommendations, irrespective of whether a complaint has been lodged. Finally, relying solely on the registered representative's self-reporting of potential issues is inadequate. While open communication is valuable, the principal's supervisory role requires independent verification and investigation, as self-reporting may not always capture the full scope of potential misconduct or may be incomplete. The professional decision-making process in such situations should involve a risk-based approach. Principals must establish clear supervisory procedures that identify potential red flags in customer complaints and trading activity. When these red flags are detected, the principal should initiate a documented investigation, which may include reviewing account documentation, communication records, and discussing the activity directly with the representative. The depth of the investigation should be commensurate with the severity and frequency of the red flags. This systematic and documented process ensures that supervisory responsibilities are met and that potential violations are addressed promptly and effectively. Question 5. Regulatory review indicates that a firm's principal is overseeing the formation of an underwriting syndicate for an upcoming initial public offering IPO. The principal is considering several approaches to manage the syndicate's responsibilities and the allocation of shares. Which of the following approaches best aligns with regulatory expectations for underwriting agreements and syndicates? Option A. The principal allows the lead underwriter, who is a different firm, to unilaterally determine the allocation of shares to syndicate members based on their perceived importance to the lead underwriter's business. Option B. The principal focuses solely on the firm's own allocation of shares and does not establish specific guidelines for how other syndicate members should manage their allocations or handle unsold shares. Option C. The principal delegates the responsibility of drafting the syndicate agreement entirely to the junior registered representatives involved in the offering, with minimal principal review. Option D. The principal ensures that a comprehensive syndicate agreement is drafted and executed by all members, clearly outlining each member's participation, responsibilities, underwriting commitment, and the methodology for allocating shares, including provisions for the stabilization of the offering. The correct answer is D. The principal ensures that a comprehensive syndicate agreement is drafted and executed by all members, clearly outlining each member's participation, responsibilities, underwriting commitment, and the methodology for allocating shares, including provisions for the stabilization of the offering. Explanation. This scenario presents a challenge for a general securities principal regarding the formation and management of an underwriting syndicate for a new public offering. The principal must ensure compliance with FINRA rules, specifically those governing underwriting arrangements and syndicate management, to prevent potential conflicts of interest, ensure fair allocation, and maintain market integrity. The principal's responsibility extends to overseeing the actions of registered representatives within their firm and ensuring the syndicate operates in accordance with regulatory requirements. The correct approach involves establishing clear guidelines for syndicate participation, including the allocation of shares, the responsibilities of each syndicate member, and the process for handling unsold shares. This proactive stance ensures that the underwriting process is conducted fairly and transparently, adhering to FINRA expectations for orderly markets and investor protection. Specifically, FINRA Rule 5130 now superseded by Rule 5131, but the principles remain, and related interpretations emphasize the importance of fair distribution of new issues and the prohibition of preferential treatment. A principal's duty includes ensuring that their firm's participation and management of a syndicate do not violate these principles, such as by engaging in spinning or other manipulative practices. An incorrect approach would be to allow syndicate members to dictate terms without principal oversight, potentially leading to preferential allocations to favored clients or the firm's own accounts, which violates the spirit and letter of FINRA rules regarding fair distribution. Another incorrect approach is to fail to establish a clear process for the stabilization of the offering, leaving the firm and other syndicate members exposed to market risk without a defined strategy, which can be seen as a failure to adequately manage the underwriting process. Finally, neglecting to document the syndicate agreement and the rationale for share allocations can create an environment ripe for regulatory scrutiny and potential accusations of impropriety. As it lacks transparency and accountability, professionals should approach such situations by prioritizing regulatory compliance and ethical conduct. This involves a thorough understanding of applicable FINRA rules, establishing robust internal policies and procedures for syndicate formation and management, and maintaining diligent oversight of all underwriting activities. A key decision-making framework involves a risk-based assessment, identifying potential areas of non-compliance or ethical compromise, and implementing controls to mitigate those risks. Open communication with syndicate members and clear documentation of all decisions are also crucial. Question 6. Consider a scenario where a publicly traded company's existing shareholders wish to sell a significant block of their privately held shares to the public. The company itself will not be issuing any new shares, and the proceeds from the sale will go directly to these selling shareholders. As a general securities principle overseeing the firm's involvement in this transaction, which of the following accurately categorizes this offering and dictates the primary regulatory considerations? Option A. This is a secondary offering, where existing shareholders are selling their shares, and the primary regulatory focus will be on the selling shareholders' disclosures and the registration of the resale of these securities. Option B. This is a follow-on offering, meaning the company is issuing additional shares to raise capital, and the prospectus must detail how the new capital will be used. Option C. This is an initial public offering, IPO, requiring the company to file a full registration statement and prospectus detailing its business operations and financial history for the first time. Option D. This is a private placement and therefore no public registration statement or prospectus is required. The correct answer is C. This is an initial public offering, IPO, requiring the company to file a full registration statement and prospectus detailing its business operations and financial history for the first time. Explanation. Scenario analysis. This scenario is professionally challenging because a principal must ensure that all communications and activities related to a new securities offering are compliant with SEC regulations, specifically regarding the distinction between different types of offerings and the associated disclosure requirements. Mischaracterizing an offering can lead to significant regulatory violations, investor confusion, and potential legal repercussions. The principal's responsibility is to oversee the firm's adherence to these rules, requiring a thorough understanding of the nuances between an IPO, a follow-on offering, and a secondary offering. Correct approach analysis. The correct approach involves accurately identifying the offering as a secondary offering. This is because the shares are being sold by existing shareholders, not by the company itself to raise new capital. In a secondary offering, the company is not issuing new shares, and therefore, the proceeds from the sale go directly to the selling shareholders. This distinction is critical under SEC rules, as it impacts the type of registration statement required, e.g., Form S-1 for an IPO, Form S-3 for certain follow-on and secondary offerings if eligibility requirements are met, and the disclosures that must be made. The principal must ensure the firm's internal documentation and external communications correctly reflect this nature of the transaction to avoid misleading investors and regulators. Incorrect approaches analysis. An approach that treats this as an initial public offering, IPO, is incorrect because an IPO involves the first sale of stock by a private company to the public. In this scenario, the company has already been public, and the shares are being sold by existing shareholders. Mischaracterizing it as an IPO would imply the company is raising new capital for the first time, which is factually inaccurate and would lead to the filing of incorrect registration statements and potentially misleading disclosures. An approach that classifies this as a follow-on offering is also incorrect. While a follow-on offering involves the sale of additional securities by a company that is already publicly traded, it typically refers to the company issuing and selling new shares to raise additional capital. In this case, the shares are being sold by existing shareholders, not by the company issuing new stock. This mischaracterization could lead to confusion about the purpose of the offering and the use of proceeds. An approach that suggests no specific classification is needed because the company is already public is incorrect. Regulatory frameworks, particularly those governed by the SEC, require precise classification of offerings due to the distinct disclosure, registration, and marketing requirements associated with each type. Failing to classify accurately can result in noncompliance with rules governing prospectuses, advertising, and insider trading disclosures. Professional reasoning. Professionals should first ascertain the fundamental nature of the transaction. Are new shares being issued by the company, or are existing shares being sold by current holders? This involves reviewing the issuer's filings, the proposed transaction structure, and the intended use of proceeds. If new shares are being issued by the company, it's either an IPO or a follow-on offering. If existing shares are being sold by shareholders, it's a secondary offering. The principal must then ensure that all subsequent actions, including prospectus preparation, marketing materials, and internal compliance procedures, align with the correct classification according to SEC regulations. This systematic approach prevents misrepresentation and ensures regulatory adherence. Question 7. The audit findings indicate a consistent pattern of registered representatives taking an excessive amount of time to acknowledge and resolve customer complaints, potentially violating firm policies and regulatory expectations for timely complaint handling. As a general securities principle, what is the most appropriate immediate action to address this systemic issue? Option A. Initiate a firm-wide review of complaint handling procedures. Identify the root causes of the delays and implement targeted training and process improvements, while also reporting the findings and proposed actions to senior management. Option B. Document the audit findings in the firm's compliance manual and instruct registered representatives to refer to it for guidance on complaint resolution timelines. Option C. Advise individual registered representatives to prioritize their pending complaints and remind them of the firm's internal deadlines for response. Option D. Focus on addressing the most severe complaints first and defer action on less critical ones until the backlog is reduced. Correct answer is A. Initiate a firm-wide review of complaint handling procedures, identify the root causes of the delays, and implement targeted training and process improvements, while also reporting the findings and proposed actions to senior management. Explanation. The audit findings indicate a pattern of delayed responses to customer complaints, which poses a significant professional challenge. Principals are responsible for establishing and maintaining supervisory procedures that ensure prompt and fair handling of customer grievances. Failure to address complaints in a timely manner can lead to regulatory sanctions, damage to the firm's reputation, and erosion of customer trust. The challenge lies in balancing the need for thorough investigation with the imperative of swift action, all while adhering to regulatory timelines and ethical obligations. The correct approach involves immediately escalating the identified pattern of delays to senior management and initiating a review of the firm's complaint handling procedures. This demonstrates proactive risk management and a commitment to regulatory compliance. Specifically, FINRA Rule 3010 requires member firms to establish and maintain a supervisory system reasonably designed to achieve compliance with applicable securities laws and regulations. This includes procedures for handling customer complaints. Promptly addressing systemic issues like delayed responses is a core component of such a system. Furthermore, ethical principles dictate that firms should treat customers fairly and with due diligence, which necessitates timely resolution of their concerns. An incorrect approach would be to dismiss the audit findings as isolated incidents, or to assume that individual registered representatives will eventually resolve their own complaints. This approach fails to recognize the systemic nature of the problem and neglects the principal's supervisory responsibility under FINRA rules. It also risks further regulatory scrutiny and potential disciplinary action for failing to implement adequate supervisory procedures. Another incorrect approach is to focus solely on documenting the delays without taking corrective action. While documentation is important, it does not address the root cause of the problem or mitigate the ongoing risk to customers and the firm. This passive stance is inconsistent with the proactive supervisory duties of a principal. A further incorrect approach is to implement a superficial fix, such as simply reminding staff about complaint handling deadlines, without investigating the underlying reasons for the delays. This superficial response is unlikely to resolve the issue and may lead to continued noncompliance. It fails to address potential systemic issues such as inadequate staffing, insufficient training, or flawed internal processes. The professional decision-making process for similar situations should involve a systematic approach. First, acknowledge and assess the severity of the audit findings. Second, identify the specific regulatory requirements and ethical obligations implicated. Third, determine the most effective and compliant course of action that addresses the root cause of the issue. And fourth, implement and monitor the corrective actions to ensure their effectiveness and ongoing compliance. Question 8. The investigation demonstrates that a general securities principal is tasked with evaluating the firm's supervisory system for establishing and maintaining compliance with applicable securities laws and regulations. The principal has reviewed the firm's written supervisory procedures and believes they are adequate. Which of the following represents the most effective approach for the principal to ensure the firm's supervisory system is reasonably designed to achieve compliance? Option A. Rely on the firm's existing written supervisory procedures, assuming they are sufficient as long as they have not been flagged by regulators or resulted in customer complaints. Option B. Conduct a thorough review of the firm's written supervisory procedures. Identify specific gaps or areas of potential noncompliance based on the firm's business activities and risk profile, and develop targeted enhancements to address these findings. Option C. Delegate the entire responsibility for evaluating and enhancing the supervisory system to the compliance department without active principal oversight. Option D. Focus solely on the firm's written supervisory procedures, assuming that if they are comprehensive, the system is inherently effective. The correct answer is B. Conduct a thorough review of the firm's written supervisory procedures, identify specific gaps or areas of potential noncompliance based on the firm's business activities and risk profile, and develop targeted enhancements to address these findings. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a general securities principle to balance the firm's operational efficiency with robust compliance. The principle must ensure that the supervisory system is not merely a procedural checklist, but a dynamic framework that actively mitigates risk and upholds regulatory standards. The challenge lies in identifying potential weaknesses in existing processes and implementing corrective actions that are both effective and practical, without unduly burdening the firm or its employees. This requires a deep understanding of FINRA rules and a proactive approach to supervision. Correct approach analysis. The correct approach involves a comprehensive review of the firm's existing supervisory procedures, identifying specific gaps or areas of potential noncompliance, and then developing targeted enhancements. This aligns with FINRA Rule 3110, Supervision, and Rule 3120, Supervisory System and Written Procedures, which mandate that member firms establish, maintain, and enforce a supervisory system reasonably designed to achieve compliance with applicable securities laws and regulations. A principal must not only identify weaknesses, but also implement concrete, measurable improvements. This proactive and systematic approach demonstrates a commitment to best practices in establishing and maintaining a supervisory system. Incorrect approaches analysis. One incorrect approach involves relying solely on the firm's existing written supervisory procedures without conducting an independent assessment of their effectiveness in practice. This fails to acknowledge that written procedures are only effective if they are consistently applied and adequately monitored, neglects the principal's responsibility to ensure the system is reasonably designed and actively enforced. Another incorrect approach is to focus only on addressing issues identified by regulators or through customer complaints. While these are important triggers for review, a truly effective supervisory system requires ongoing, proactive evaluation to prevent issues before they arise. This reactive stance falls short of the preventative measures expected of a principal. A third incorrect approach is to delegate the entire responsibility for evaluating and enhancing the supervisory system to compliance staff without active principal oversight and involvement. While compliance staff play a crucial role, the ultimate responsibility for the adequacy of the supervisory system rests with the principal. This abdication of responsibility is a significant regulatory failure. Professional reasoning. Professionals should approach the establishment and maintenance of a supervisory system by first understanding the firm's business activities and associated risks. This understanding should then inform a thorough review of existing written supervisory procedures, followed by an assessment of their practical implementation through testing and monitoring. Any identified deficiencies should be addressed with specific, actionable corrective measures, and the effectiveness of these measures should be periodically reevaluated. This cyclical process of review, implementation, and reevaluation is key to maintaining a robust and compliant supervisory framework. Question 9. The analysis reveals that a firm is considering offering a new type of structured product to its retail clients. The product's complexity and novel features raise concerns about potential disclosure challenges and suitability requirements under SEC regulations. Which of the following approaches best aligns with the responsibilities of a general securities principal in this situation? Option A. Proceed with offering the product, assuming that the firm's standard disclosure and suitability processes are adequate, and address any specific concerns that arise after the product has been launched. Option B. Initiate a thorough review of the firm's existing disclosure and suitability procedures, comparing them against current SEC rules and guidance applicable to structured products, and develop any necessary enhancements to ensure full compliance before offering the product. Option C. Delegate the entire responsibility for assessing the regulatory compliance of the new product to the firm's junior compliance analyst, trusting their judgment to identify any significant issues. Option D. Prioritize the potential revenue from the new product and instruct the compliance department to expedite the review process, focusing only on the most critical disclosure elements to avoid delaying the launch. The correct answer is B. Initiate a thorough review of the firm's existing disclosure and suitability procedures, comparing them against current SEC rules and guidance applicable to structured products, and develop any necessary enhancements to ensure full compliance before offering the product. Explanation. This scenario presents a professional challenge because a principal must balance the firm's operational efficiency and potential revenue generation with strict adherence to SEC regulations designed to protect investors and maintain market integrity. The principal's judgment is critical in ensuring that the firm's practices do not inadvertently create risks or violate disclosure requirements. The correct approach involves proactively identifying and addressing potential regulatory gaps before they lead to violations. This demonstrates a commitment to compliance and risk management, which is a core responsibility of a general securities principal. Specifically, the principal should initiate a review of the firm's current practices against the latest SEC guidance and rules concerning the specific product or service in question. This proactive stance ensures that the firm operates within the bounds of the law, minimizes the risk of enforcement actions, and upholds its fiduciary duty to clients. Regulatory justification stems from the SEC's mandate to oversee securities markets and enforce rules designed to prevent fraud and manipulation, as well as ensure fair and orderly markets. Principals are responsible for supervising the firm's activities and ensuring compliance with all applicable federal securities laws and regulations. An incorrect approach would be to assume that existing procedures are sufficient without verification. This passive stance ignores the dynamic nature of SEC regulations and guidance, which are frequently updated. Relying on outdated practices can lead to unintentional violations, exposing the firm and its personnel to significant penalties, reputational damage, and potential loss of registration. This failure to exercise due diligence and supervision is a direct contravention of a principal's responsibilities under SEC rules. Another incorrect approach is to prioritize revenue generation over regulatory compliance. This might involve overlooking minor discrepancies or delays in implementing new compliance measures if they are perceived to hinder business operations or profitability. Such a mindset is fundamentally flawed and ethically unsound, as it places financial gain above investor protection and legal obligations. The SEC strictly prohibits practices that could be deemed manipulative or deceptive, and prioritizing profit over compliance can easily lead to such outcomes. A third incorrect approach is to delegate the entire responsibility for regulatory interpretation and implementation to junior staff without adequate oversight or validation. While delegation is a necessary management tool, a principal cannot abdicate their ultimate responsibility for ensuring compliance. This failure to provide adequate supervision and guidance to staff can result in systemic compliance failures that the principal should have identified and corrected. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This includes 1. Identifying potential regulatory touchpoints for new products or services. 2. Consulting relevant SEC rules, regulations, and interpretive releases. 3. Assessing the firm's current policies and procedures against these requirements. 4. Identifying any gaps or areas of uncertainty. 5. Developing and implementing corrective actions or new procedures. And 6. Establishing ongoing monitoring and review mechanisms. This proactive and systematic approach ensures that compliance is integrated into business operations from the outset. Question 10. Risk assessment procedures indicate that a broker-dealer firm is expanding its offerings to include futures and options on futures. As the general securities principal, which of the following actions is most critical to ensure compliance with the Commodity Futures Trading Commission's (CFTC) oversight of these products? Option A. Rely on the firm's existing general securities supervision policies and procedures, assuming they are sufficient to cover the oversight of futures and options on futures. Option B. Develop and implement specific written supervisory procedures that address the unique risks, sales practices, and record-keeping requirements associated with futures and options on futures, and ensure registered persons receive adequate training on these procedures and relevant CFTC regulations. Option C. Ensure that all registered persons involved in the sale of futures and options on futures are registered with the CFTC, as this registration inherently satisfies regulatory oversight requirements. Option D. Delegate the entire responsibility for developing and monitoring compliance with CFTC regulations to the firm's compliance department, without direct principal involvement in the procedural development. The correct answer is B. Develop and implement specific written supervisory procedures that address the unique risks, sales practices, and record-keeping requirements associated with futures and options on futures, and ensure registered persons receive adequate training on these procedures and relevant CFTC regulations. Explanation: this scenario is professionally challenging because it requires a general securities principal to understand and apply the Commodity Futures Trading Commission's (CFTC) oversight responsibilities, specifically concerning futures and options on futures, within the context of their firm's compliance program. The principal must ensure that the firm's procedures adequately address the unique risks associated with these products, and that registered persons are properly supervised. The difficulty lies in distinguishing between general securities regulations and the specific, often more complex, rules governing derivatives. Correct approach involves establishing and maintaining a robust supervisory system that specifically addresses the risks inherent in futures and options on futures. This includes implementing policies and procedures for sales practices, advertising, record-keeping, and training that are tailored to these instruments. The principal must ensure that registered persons understand the CFTC regulatory framework, including registration requirements, prohibited practices, and reporting obligations. This proactive and product-specific approach aligns with FINRA Rule 3110, supervision, and the broader principles of the Securities Exchange Act of 1934, which mandate effective supervision to prevent fraud and manipulation, and ensures compliance with CFTC regulations. An incorrect approach would be to rely solely on general security supervision procedures, without considering the specific nuances of futures and options on futures. This failure to account for product-specific risks could lead to violations of CFTC regulations, such as inadequate disclosure of risks, improper suitability determinations, or insufficient record-keeping, exposing both the firm and its associated persons to regulatory action and client complaints. Another incorrect approach is to assume that CFTC registration for the firm or its associated persons automatically negates the need for specific internal supervisory procedures. While registration is a prerequisite, It does not absolve the principal of the responsibility to implement and enforce effective compliance policies and procedures that address the unique regulatory landscape governed by the CFTC. A third incorrect approach is to delegate the entire responsibility for CFTC compliance to a compliance department without active principal oversight. While the compliance department plays a crucial role, the ultimate responsibility for establishing and maintaining a supervisory system rests with the principal. Failure to actively engage in and oversee the development and implementation of these procedures represents a dereliction of duty. Professional reasoning in such situations requires a thorough understanding of the firm's business activities, including any involvement with futures and options on futures. Principals must proactively identify potential regulatory gaps, consult relevant CFTC rules and guidance, and collaborate with legal and compliance departments to develop and implement appropriate supervisory controls. Regular training and ongoing monitoring are essential to ensure that these controls remain effective and that registered persons adhere to all applicable regulations. Question 11. To address the challenge of ensuring compliance with communication regulations in the digital age, a general securities principle is reviewing the firm's policies regarding the use of social media by its registered representatives. Which of the following approaches best aligns with the regulatory framework governing broker-dealers and their principals, considering the oversight roles of both FINRA and the SEC? Option A. Focus solely on FINRA Rule 2210 requirements for communications, assuming that SEC guidance on social media is less critical for broker-dealer compliance. Option B. Consider personal social media accounts of registered representatives to be outside the firm's regulatory responsibility, provided they do not explicitly mention the firm's name. Option C. Adopt a reactive compliance strategy, addressing social media issues only when specific complaints or regulatory inquiries arise. Option D. Develop and implement a comprehensive social media policy that incorporates requirements from FINRA Rule 2210 and relevant SEC guidance, mandating pre-approval for certain content and establishing clear record-keeping procedures. The correct answer is D. Develop and implement a comprehensive social media policy that incorporates requirements from FINRA Rule 2210 and relevant SEC guidance, mandating pre-approval for certain content and establishing clear record-keeping procedures. Explanation. Scenario analysis. This scenario presents a professional challenge for a general securities principal because it requires navigating the complex interplay between a registered broker-dealer's internal compliance procedures and the oversight of multiple regulatory bodies, specifically the Securities and Exchange Commission, SEC, and FINRA. The principal must ensure that all communications, particularly those involving social media, are not only compliant with FINRA rules, but also align with the broader regulatory expectations set by the SEC regarding investor protection and market integrity. The challenge lies in interpreting and applying potentially overlapping or nuanced rules from different, albeit related, regulatory authorities to a rapidly evolving communication medium. Failure to do so can result in significant disciplinary actions, fines, and reputational damage. Correct approach analysis. The correct approach involves proactively establishing and enforcing a comprehensive social media policy that explicitly addresses the requirements of both FINRA Rule 2210, communications with the public, and SEC guidance on social media use by investment advisors and broker-dealers. This policy should mandate pre-approval for certain types of posts, outline record-keeping requirements for electronic communications, and include training for all associated persons on permissible content and disclosure obligations. This approach is correct because it directly addresses the regulatory obligations under FINRA Rule 2210, which governs communications with the public, and incorporates the SEC's broader mandate for investor protection and fair dealing. By ensuring that the firm's policy is robust and covers these key areas, the principal demonstrates due diligence in supervising communications and mitigating compliance risks. Incorrect approaches analysis. Relying solely on FINRA existing rules without considering SEC guidance on social media is an incorrect approach because it creates a compliance gap. While FINRA Rule 2210 provides a framework for communications, the SEC has issued specific interpretations and guidance that may impose additional obligations or clarify expectations for digital communication, particularly concerning the use of social media platforms by financial professionals. Ignoring this SEC guidance could lead to noncompliance with broader federal securities laws. Adopting a wait-and-see approach, where the firm only reacts to specific complaints or regulatory inquiries regarding social media use, is also incorrect. This reactive stance fails to meet the proactive supervisory responsibilities of a principal. Regulatory bodies expect firms to anticipate potential compliance issues and implement preventative measures. A passive approach increases the likelihood of violations and demonstrates a lack of commitment to robust compliance. Assuming that personal social media accounts used by associated persons are entirely outside the firm's regulatory purview is a dangerous and incorrect assumption. FINRA Rule 2210 and SEC guidance generally extend to communications that can be attributed to the firm or its associated person, even if conducted on personal platforms, especially if they relate to the firm's business or securities. Principals have a duty to supervise communications that could impact the firm's reputation or involve the offer or sale of securities. Professional reasoning. Professionals in this role must adopt a proactive and comprehensive compliance strategy. This involves staying abreast of all relevant regulations and guidance from all applicable regulatory bodies, including FINRA and the SEC, when developing or updating policies, especially concerning new communication channels like social media. It is crucial to consider the spirit and letter of all regulatory requirements. A risk-based approach, identifying potential areas of noncompliance and implementing controls before issues arise, is paramount. Regular training and clear communication of policies to all supervised persons are essential components of effective supervision. Question 12. The review process indicates that several registered representatives are approaching the deadline for completing their annual continuing education requirements, as mandated by FINRA Rule 1120B. As a general securities principle, what is the most appropriate course of action to ensure the firm remains in compliance? Option A. Send out a firm-wide email reminding all registered representatives that their continuing education is due soon and that they are responsible for completing it on time. Option B. Proactively identify representatives whose continuing education is due within the next 90 days, provide them with a list of approved CE providers and modules, and schedule follow-up reminders for those who have not yet completed their requirements. Option C. Assume that registered representatives are aware of their continuing education obligations and will complete them independently, as it is their personal professional responsibility. Option D. Implement a mandatory, firm-wide in-person continuing education seminar for all registered representatives within the next month, regardless of their individual CE status or deadlines. Correct answer is A. Send out a firm-wide email reminding all registered representatives that their continuing education is due soon and that they are responsible for completing it on time. Explanation. This scenario presents a professional challenge because a principal is tasked with ensuring compliance with FINRA continuing education requirements for registered representatives, while also managing operational efficiency and potential resource constraints. The principal must balance the firm's obligation to maintain a compliant workforce with the practicalities of implementing and tracking training. Careful judgment is required to select an approach that is both regulatory sound and operationally feasible. The correct approach involves proactively identifying representatives who are approaching their CE deadlines and providing them with clear guidance and accessible resources to complete their requirements. This demonstrates a commitment to regulatory compliance and supports the registered representatives in fulfilling their professional obligations. Specifically, FINRA Rule 1120B mandates that all registered persons complete the regulatory element of the CE program. Firms are responsible for ensuring their registered persons comply with this rule. By actively reminding and assisting representatives, the principal fulfills the firm's supervisory responsibility to ensure compliance. This proactive stance minimizes the risk of violations and ensures the firm's representatives remain qualified to conduct business. An incorrect approach would be to simply rely on the representative to remember their CE obligations. This fails to meet the firm's supervisory responsibility under FINRA rules. It creates a significant risk of noncompliance, as individuals may forget or overlook their deadlines, leading to potential sanctions for both the representative and the firm. Another incorrect approach would be to mandate a single, firm-wide training session for all representatives, regardless of their individual CE status or specific needs. While this might seem efficient, it fails to acknowledge that CE requirements are individualized and may have different deadlines. It also might not be the most effective use of resources or the most targeted approach to ensure compliance for those who are actually due. Furthermore, it doesn't address the specific requirement for the regulatory element, which is often delivered through a standardized module. A third incorrect approach would be to delegate the entire responsibility for tracking and ensuring CE completion to the registered representatives themselves without any oversight or support from the firm. This abdicates the firm's supervisory duty and places an undue burden on individuals, increasing the likelihood of noncompliance. The firm, through its principles, has a fundamental obligation to supervise its registered persons and ensure they meet all regulatory requirements, including continuing education. The professional decision-making process for similar situations should involve understanding the specific regulatory requirements, assessing the firm's current processes for tracking compliance, identifying potential gaps or risks, and then implementing a proactive and supportive system. This includes clear communication, provision of resources, and regular monitoring to ensure ongoing adherence to all applicable rules. Question 13. What factors determine the adequacy of a firm's supervisory system for monitoring registered representatives' trading activities to ensure compliance with regulatory requirements and ethical standards? Option A. The frequency of internal audits, regardless of whether those audits are specifically designed to detect trading irregularities or are conducted by individuals with expertise in trading surveillance. Option B. The scope and nature of the firm's business, the types of securities traded, the volume of trading activity, and the firm's established policies and procedures for identifying and investigating suspicious trading patterns. Option C. The extent to which registered representatives self-report any unusual trading activity, assuming a high level of personal integrity. Option D. The number of customer complaints received regarding trading activity, as this is the primary indicator of potential misconduct. The correct answer is B. The scope and nature of the firm's business, the types of securities traded, the volume of trading activity, and the firm's established policies and procedures for identifying and investigating suspicious trading patterns. Explanation. This scenario is professionally challenging because it requires a principal to balance the firm's obligation to supervise registered representatives with the practicalities of monitoring trading activity without unduly infringing on representative autonomy or creating an overly burdensome compliance program. The principal must exercise sound judgment to identify potential misconduct while ensuring the monitoring system is effective and compliant with FINRA rules. The correct approach involves establishing a comprehensive surveillance program that utilizes a combination of automated systems and periodic manual reviews. This program should be designed to flag suspicious trading patterns, such as excessive trading, trading in illiquid securities, or trading that appears to benefit the representative at the client's expense. The principal's responsibility is to ensure this system is adequately designed, implemented, and tested, and that any flagged activity is promptly and thoroughly investigated. Regulatory justification stems from FINRA Rule 3110, Supervision, and Rule 2090, Best Execution, which mandate that firms establish and maintain a supervisory system reasonably designed to achieve compliance with applicable securities laws and regulations, including ensuring that customer orders are executed at the best possible price. Furthermore, the duty to supervise extends to monitoring for potential fraud and manipulative practices. An incorrect approach would be to rely solely on customer complaints to detect trading irregularities. This is a reactive measure that fails to meet the proactive supervisory obligations. By the time a customer complains, significant harm may have already occurred, and the firm may have violated its duty to supervise. This approach neglects the firm's responsibility to identify and prevent misconduct before it impacts clients. Another incorrect approach is to implement an overly broad and intrusive monitoring system that flags every minor deviation without a clear rationale or threshold for investigation. While appearing thorough, such a system can lead to excessive false positives, overwhelming the compliance department, and diluting the focus on genuinely suspicious activity. This can be inefficient and may not be considered reasonably designed to achieve compliance, as it lacks targeted effectiveness. A third incorrect approach is to delegate the entire responsibility for monitoring registered representatives trading to the representatives themselves, with only minimal oversight. This abdication of supervisory responsibility is a clear violation of FINRA rules. Principals are ultimately accountable for the firm's supervisory system and must actively engage in its design, implementation, and ongoing review. The professional decision-making process for similar situations should involve a risk-based approach. Principals must assess the types of trading activities conducted by their firm and representatives, identify potential risks associated with those activities, and then design and implement monitoring procedures that are specifically tailored to mitigate those risks. This includes leveraging technology, establishing clear investigation protocols, and ensuring adequate training for both supervisors and registered representatives. Regular review and updating of the surveillance program are also crucial to adapt to evolving market practices and regulatory expectations. Question 14. The control framework reveals that a firm is considering hiring an individual to assist with client communications and administrative tasks related to investment accounts. This individual will not be directly involved in making investment recommendations or executing trades, but will handle inquiries from clients about their account status and process paperwork for account openings and transfers. The firm's compliance department is debating whether this individual needs to be registered as an associated person under FINRA Rule 0100 series. What is the most appropriate course of action for the firm's principal? Option A. Register the individual only as a clerical employee, as this designation is sufficient for individuals performing administrative functions without direct sales responsibilities. Option B. Seek an exemption from FINRA for this specific role, arguing that the administrative nature of the duties does not warrant the burden of registration. Option C. Do not register the individual, as their role is primarily administrative and they are not making investment recommendations or executing trades, thus not fitting the core definition of a registered representative. Option D. Register the individual as an associated person, as their role involves direct client interaction and handling of account-related documentation, which falls within the broad scope of activities defined by FINRA for associated persons. The correct answer is D. Register the individual as an associated person, as their role involves direct client interaction and handling of account-related documentation, which falls within the broad scope of activities defined by FINRA for associated persons. Explanation. The control framework reveals a potential conflict between a firm's operational needs and the strict adherence to FINRA Rule 0100 series definitions, specifically concerning the definition of associated person. This scenario is professionally challenging because it requires a principal to interpret and apply regulatory definitions in a practical business context, balancing efficiency with compliance. The principal must ensure that all individuals acting on behalf of the firm in a manner that requires registration are properly identified and registered, even if their roles are not immediately obvious, or if the firm seeks to categorize them differently for internal purposes. The correct approach involves a thorough review of the individual's activities against the definition of associated person, as outlined in FINRA Rule 0100 series. This definition is broad and encompasses individuals engaged in the securities business on behalf of a member firm, including those involved in sales, management, supervision, and even clerical functions that are incidental to the securities business. If the individual's duties, even if part-time or in a supporting role, involve activities that fall under this definition, they must be registered. This ensures that all individuals interacting with the public or handling customer accounts are subject to FINRA oversight, ethical standards, and continuing education requirements, thereby protecting investors and maintaining market integrity. An incorrect approach would be to rely solely on the individual's job title or the firm's internal classification if those do not align with the regulatory definition. For instance, classifying someone as a consultant or administrative assistant without examining their actual duties would be a failure. If this consultant is indeed soliciting business, discussing investment products with clients, or performing any function that FINRA considers part of the securities business, they are an associated person and must be registered. This failure to register an associated person is a direct violation of FINRA rules and exposes the firm and the individual to disciplinary action, fines, and reputational damage. Another incorrect approach would be to assume that because the individual is not directly involved in sales, they do not need to be registered. FINRA definition is inclusive, and individuals in supervisory or operational roles that support the securities business may also be considered associated persons. Ignoring this broad interpretation can lead to gaps in supervision and compliance. The professional decision-making process should begin with a clear understanding of the relevant FINRA definitions, particularly those in the 0100 series. When faced with an ambiguous situation, the principle of investor protection should guide the decision. If there is any doubt about whether an individual's activities require registration, the prudent and compliant course of action is to err on the side of caution and ensure registration. This involves a detailed analysis of the individual's responsibilities, consultation with compliance personnel, and, if necessary, seeking clarification from FINRA. The ultimate goal is to maintain a robust compliance program that accurately reflects the firm's activities and adheres to all regulatory requirements. Question 15. Strategic planning requires a general securities principal to evaluate the effectiveness of their firm's Office of Foreign Assets Control (OFAC) compliance program. The firm has experienced a recent increase in international client onboarding, and the principal is concerned about potential exposure to sanctioned individuals or entities. The principal is considering several options to address this concern. Which of the following approaches best aligns with OFAC compliance requirements and the principal's supervisory responsibilities? Option A. Implement a new, highly complex screening protocol that requires extensive documentation for every client, regardless of perceived risk, to ensure absolute certainty of compliance. Option B. Instruct the compliance department to perform a one-time manual review of all existing client accounts against the most recent OFAC list, assuming the screening software is generally reliable. Option C. Rely on the firm's existing screening software, which was last updated 18 months ago, and assume it captures all necessary sanctions information, while focusing resources on other business development initiatives. Option D. Update the firm's OFAC screening software with the latest sanctions lists, conduct mandatory refresher training for all client-facing staff on OFAC regulations and the firm's updated procedures, and establish a clear protocol for investigating and reporting any potential matches identified by the screening system. The correct answer is D. Update the firm's OFAC screening software with the latest sanctions lists, conduct mandatory refresher training for all client-facing staff on OFAC regulations and the firm's updated procedures, and establish a clear protocol for investigating and reporting any potential matches identified by the screening system. Explanation: this scenario is professionally challenging because it requires a principal to balance the firm's operational efficiency with stringent regulatory obligations concerning OFAC compliance. The principal must ensure that the firm's procedures are not only effective in preventing transactions with sanctioned individuals or entities, but also practical to implement without unduly hindering legitimate business. The risk of non-compliance, which can result in severe penalties, necessitates a proactive and informed approach. The correct approach involves a comprehensive review and enhancement of the firm's existing OFAC compliance program, specifically targeting the screening process for new and existing clients. This includes updating the firm's screening software with the latest OFAC lists, implementing regular training for relevant staff on OFAC regulations and the firm's procedures, and establishing a clear escalation protocol for any potential matches. This approach is correct because it directly addresses the core requirements of OFAC regulations, which mandate robust screening and due diligence to prevent dealings with sanctioned parties. FINRA Rule 3310, which incorporates OFAC requirements, emphasizes the need for firms to establish and maintain supervisory procedures reasonably designed to achieve compliance with applicable anti-money laundering (AML) and OFAC sanctions programs. Proactive training and updated screening tools are essential components of such procedures. An incorrect approach would be to rely solely on the existing screening software without verifying its currency or the frequency of updates. This is a regulatory failure because OFAC lists are dynamic and require continuous monitoring. Failing to ensure the software is up to date means the firm could inadvertently transact with newly added sanctioned entities, violating OFAC regulations. Another incorrect approach would be to delegate the entire OFAC compliance responsibility to a single, junior employee without adequate oversight or specialized training. This is an ethical and regulatory failure because it demonstrates a lack of commitment from senior management to compliance and places an undue burden on an individual who may not possess the necessary expertise or authority to implement and enforce effective controls. Principals have a supervisory responsibility to ensure that compliance functions are adequately resourced and managed. A third incorrect approach would be to implement a screening process that is overly burdensome and disruptive to client onboarding, leading to significant delays and potential loss of business, without a clear risk-based justification. While compliance is paramount, it must be balanced with operational feasibility. An overly restrictive process, without a clear link to mitigating specific OFAC risks, could indicate a misunderstanding of the proportionality required in compliance measures and may not be considered reasonably designed. The professional decision-making process for similar situations should involve a risk-based assessment of the firm's current compliance posture, a thorough understanding of OFAC regulations and their implications, and a commitment to investing in appropriate technology and personnel. Principals should regularly review and test their compliance programs, seek expert advice when necessary, and foster a culture of compliance throughout the organization. Question 16. Strategic planning requires a principal to ensure a firm's business continuity plan, BCP, is robust and compliant. Considering the regulatory framework for FINRA member firms, which of the following represents the most effective and compliant approach to implementing and maintaining a BCP? Option A. Regularly testing the BCP through simulations of various disaster scenarios and updating the plan based on test results and changes in the firm's operations or the threat landscape. Option B. Documenting detailed recovery procedures and assuming their effectiveness without conducting regular, practical tests. Option C. Conducting BCP tests only annually and prioritizing cost-saving measures over the thoroughness of simulation exercises. Option D. Adopting a generic industry-standard BCP template and applying it directly to the firm without significant customization. The correct answer is A. Regularly testing the BCP through simulations of various disaster scenarios and updating the plan based on test results and changes in the firm's operations or the threat landscape. Explanation. This scenario presents a professional challenge because a principal must ensure that a firm's business continuity plan, BCP, is not merely a theoretical document but a practical, tested, and effective safeguard against significant operational disruptions. The challenge lies in balancing the need for robust planning and testing with the firm's resources and the dynamic nature of potential threats. Careful judgment is required to identify the most effective and compliant approach to BCP implementation and maintenance. The correct approach involves regularly testing the BCP, including simulations of various disaster scenarios, and updating it based on the test results and changes in the firm's operations or the threat landscape. This aligns directly with FINRA Rule 4370, which mandates that member firms establish and maintain a business continuity plan. The rule emphasizes the need for testing and updating the plan to ensure its effectiveness. Regular testing allows the firm to identify weaknesses, validate recovery procedures, and train personnel, thereby fulfilling its regulatory obligation to protect customer assets and maintain operational integrity during a disruption. An approach that focuses solely on documenting procedures without regular testing fails to meet the spirit and letter of the regulations. FINRA Rule 4370 requires testing to ensure the plan is functional. Without testing, the firm cannot be reasonably assured that its recovery time objectives, RTO, and recovery point objectives, RPO, are achievable or that critical functions can be restored. An approach that relies on generic industry templates without customization to the firm's specific business model, technology, and risks is also inadequate. Templates can be a starting point. A BCP must be tailored to the unique operational environment of the firm to be effective. A generic plan may overlook critical dependencies or specific vulnerabilities relevant to that firm. An approach that prioritizes cost savings over comprehensive testing and updates by conducting only infrequent or superficial tests risks noncompliance and operational failure. The regulatory requirement for an effective BCP implies a commitment to adequate resources for testing and maintenance. Cutting corners on testing can lead to a plan that is not viable when needed, potentially resulting in significant financial and reputational damage, as well as regulatory sanctions. The professional reasoning process for similar situations should involve a thorough understanding of the regulatory requirements, FINRA Rule 4370, an assessment of the firm's specific risks and operational dependencies, the development of a tailored BCP, and a commitment to regular, realistic testing and ongoing review and updates. Principals must champion a culture of preparedness, ensuring that the BCP is a living document that is actively managed and validated. Question 17. The audit findings indicate that a registered representative has engaged in a pattern of making misleading statements to clients regarding the performance of their investments, despite prior warnings from their direct supervisor. As the general securities principal, what is the most appropriate course of action to manage this employee misconduct? Option A. Issue a verbal warning to the representative and monitor their future client interactions, assuming the previous warning from their supervisor was sufficient. Option B. Immediately terminate the representative's employment without further investigation, citing the audit findings as definitive proof of misconduct. Option C. Address the issue by reassigning the representative to a non-client-facing role and providing additional training without formally documenting the misconduct or disciplinary action. Option D. Conduct a formal investigation into the representative's conduct, review all relevant client communications and records, and implement disciplinary action consistent with firm policy and FINRA regulations, which may include suspension or termination. The correct answer is D. Conduct a formal investigation into the representative's conduct, review all relevant client communications and records, and implement disciplinary action consistent with firm policy and FINRA regulations, which may include suspension or termination. Explanation. This scenario presents a professional challenge because the principal must balance the firm's obligation to maintain a compliant and ethical environment with the need to address employee misconduct fairly and effectively. The principal's judgment is critical in determining the appropriate disciplinary action, ensuring it aligns with regulatory requirements and internal policies, while also considering the impact on employee morale and the firm's reputation. The correct approach involves a thorough investigation, documentation, and consistent application of disciplinary measures. This demonstrates the firm's commitment to regulatory compliance and ethical conduct, as required by FINRA rules. Specifically, principals have a supervisory responsibility to ensure that registered representatives adhere to all applicable securities laws and regulations, including those pertaining to ethical behavior and firm policies. Prompt and appropriate action in response to misconduct is essential to prevent further violations and to uphold the integrity of the securities markets. An incorrect approach of overlooking minor infractions, even if seemingly isolated, fails to uphold the supervisory responsibilities mandated by FINRA Rule 3010. This can create a perception of leniency, potentially encouraging further misconduct and exposing the firm to greater regulatory scrutiny and penalties. Another incorrect approach, that of immediately terminating an employee without a proper investigation, can lead to legal challenges and may not be proportionate to the offense. Violating principles of fairness and due process also fails to establish a clear record of the misconduct and the rationale for the disciplinary action, which is crucial for regulatory review. A further incorrect approach, that of applying disciplinary measures inconsistently based on personal relationships or biases, directly contravenes the principle of fair and equitable treatment and undermines the firm's internal controls and supervisory structure. This can lead to claims of discrimination and a breakdown of trust within the organization, while also failing to meet the supervisory obligations to ensure all employees are held to the same standards. The professional reasoning process should involve a systematic evaluation of the misconduct, including its nature, severity, frequency, and impact. This should be followed by a review of relevant firm policies and FINRA rules to determine appropriate disciplinary actions. Documentation of the entire process, from investigation to resolution, is paramount for demonstrating compliance and for future reference. Question 18. Quality control measures reveal that the firm's internal audit schedule has been developed without a clear methodology for prioritizing areas of review. The general securities principal must determine the most effective approach to ensure comprehensive compliance oversight. Which of the following approaches best aligns with regulatory expectations for internal audits and inspections? Option A. Delegate all internal audit responsibilities to the firm's external auditors and rely solely on their findings. Option B. Schedule internal audits exclusively in response to significant customer complaints or regulatory inquiries received. Option C. Implement a risk-based audit program that identifies and assesses potential compliance and operational risks across all firm activities, allocating audit resources accordingly. Option D. Conduct internal audits on a purely random selection of business units and processes each quarter. The correct answer is C. Implement a risk-based audit program that identifies and assesses potential compliance and operational risks across all firm activities, allocating audit resources accordingly. Explanation: this scenario presents a common challenge for a general securities principle, balancing the need for thorough internal audits with the operational realities of a busy firm. The principal must ensure that the firm's internal audit function is robust enough to identify and address potential compliance issues, thereby protecting both the firm and its clients, while also considering the practical implications of resource allocation and the potential for disruption. The challenge lies in designing an audit program that is both effective and efficient, adhering to regulatory expectations without unduly burdening the business. The correct approach involves a risk-based methodology for internal audits and inspections. This means prioritizing audit areas based on their potential for compliance violations, financial misstatement, or operational failures. A risk assessment framework allows the principal to focus limited resources on the highest risk activities, ensuring that the most critical aspects of the firm's operations are regularly and thoroughly reviewed. This aligns with FINRA Rule 3010, which requires member firms to establish and maintain a supervisory control system designed to achieve compliance with applicable securities laws and regulations. A risk-based approach is implicitly endorsed by regulatory bodies as an efficient and effective means of fulfilling these supervisory obligations. It demonstrates a proactive commitment to compliance and risk management. An incorrect approach would be to conduct audits on a purely random or arbitrary basis. This lacks a strategic focus and may miss significant risks in areas that are not randomly selected. It fails to demonstrate a systematic effort to identify and mitigate potential compliance failures, which is a core requirement of effective supervision. Another incorrect approach would be to solely rely on external audits without a robust internal audit function. While external audits provide valuable oversight, they are typically conducted less frequently and may not have the same depth of day-to-day operational insight as an internal audit. Relying exclusively on external reviews leaves the firm vulnerable to issues that may arise between external audit cycles. This approach does not fulfill the firm's ongoing responsibility for internal compliance monitoring. Finally, an incorrect approach would be to conduct audits only in response to specific customer complaints or regulatory inquiries. This reactive stance is insufficient for a principal responsible for proactive supervision. While addressing complaints and inquiries is crucial, a comprehensive internal audit program should aim to identify and prevent issues before they escalate to the point of complaint or regulatory action. This approach demonstrates a failure to implement a preventative compliance strategy. The professional reasoning process for a general securities principal in this situation should begin with understanding the firm's business activities, identifying potential risks associated with each activity, and then developing an audit plan that allocates resources to address those risks. This involves regular review and updating of the risk assessment to reflect changes in the business, regulatory landscape, and emerging threats. The principal should also ensure that audit findings are promptly addressed and that corrective actions are documented and verified. Question 19. The assessment process reveals that a broker-dealer firm's principal is reviewing the firm's record-keeping policies and procedures. The principal notes that the firm has a system for retaining trade blotters, customer account statements, and compliance-related correspondence. However, the principal is unsure whether the firm's current practices adequately capture and retain all electronic communications, such as emails and instant messages exchanged between registered representatives and customers, and between registered representatives themselves, that relate to the firm's business. The principal is considering whether these electronic communications are considered records under the applicable regulations, and what the retention requirements are for such communications. Which of the following represents the most appropriate action for the principal to take to ensure the firm's compliance with record-keeping requirements? Option A. Rely on the third-party vendor that provides the firm's email and instant messaging services to automatically handle all record-keeping and retention obligations for these communications. Option B. Confirm that the firm's electronic communication archiving system captures all business-related emails and instant messages and retains them for the required period, typically 6 years, with the first 2 years readily accessible, as mandated by SEC and FINRA rules. Option C. Implement a policy to delete all electronic communications after 60 days, as this is generally sufficient time to address any immediate business needs or inquiries. Option D. Assume that only formal written correspondence and transaction records are considered official business records requiring retention, and that informal electronic communications can be managed at the discretion of individual employees. The correct answer is B. Confirm that the firm's electronic communication archiving system captures all business-related emails and instant messages and retains them for the required period, typically 6 years, with the first 2 years readily accessible, as mandated by SEC and FINRA rules. Explanation. The assessment process reveals a common challenge for principals, ensuring that their firm's record-keeping practices align with the stringent requirements of the Securities Exchange Act of 1934 and FINRA rules. The principal's responsibility is not merely to oversee operations, but to actively ensure compliance, which includes understanding the nuances of what constitutes a record and the appropriate retention periods. This scenario is professionally challenging because a principal must balance operational efficiency with regulatory mandates, and a failure to do so can lead to significant disciplinary action, fines, and reputational damage for both the firm and the individual. The correct approach involves understanding that electronic communications, such as emails and instant messages, are considered business records and must be retained according to specific rules. This approach prioritizes compliance by recognizing the regulatory definition of a record and adhering to the established retention periods. Specifically, FINRA Rule 4511 mandates that firms maintain books and records in a manner that readily allows for examination by FINRA. This includes all communications relating to the firm's business. The retention period for such communications is typically 6 years, with the first 2 years easily accessible. Therefore, implementing a system that captures and retains these communications is paramount. An incorrect approach would be to assume that only formal written correspondence or transaction records require retention. This overlooks the broad definition of business records under SEC and FINRA regulations, which explicitly includes electronic communications. Failing to retain these communications is a direct violation of record-keeping rules, as it prevents regulators from conducting a thorough examination of the firm's activities and communications. Another incorrect approach would be to rely on the assumption that the vendor providing the communication platform handles all record-keeping obligations. While vendors may offer archiving solutions, the ultimate responsibility for compliance rests with the broker-dealer firm and its principals. The firm must ensure that the vendor system meets regulatory requirements, including accessibility and retention periods, and that the firm has a process to verify this. A third incorrect approach would be to delete electronic communications after a short, arbitrary period, such as 30 or 60 days, believing they are not significant or are personal in nature. This is a critical error, as any communication related to the firm's business, regardless of perceived significance or the sender's intent, must be retained. The regulatory framework does not allow for subjective judgment on the importance of communications for retention purposes. All relevant communications are subject to the rules. The professional decision-making process for principals in such situation should involve a proactive and systematic approach to compliance. This includes 1. Thoroughly understanding all applicable record-keeping rules, SEC Rule 17A4, FINRA Rule 4511, etc. 2. Regularly reviewing the firm's record-keeping policies and procedures to ensure they are current and comprehensive. 3. Implementing and maintaining robust systems for capturing, storing, and retrieving all required records, including electronic communications. 4. Conducting periodic internal audits to verify compliance. 5. Providing ongoing training to all staff on record-keeping responsibilities. Question 20. The control framework reveals that a broker-dealer's investment banking division is advising a public company on a potential acquisition. The firm's research department has recently published a positive report on the target company, and the firm's trading desk has a significant proprietary position in the target company's stock. The principal is aware of these potential conflicts of interest. Which of the following represents the most appropriate course of action for the principal to ensure compliance with regulatory requirements and ethical standards? Option A. Structure the advisory agreement to prioritize the firm's compensation, even if it means recommending a transaction that may not be the absolute best financial outcome for the client. Option B. Ensure full disclosure of all potential conflicts of interest to the client being advised, and implement internal procedures to mitigate the impact of these conflicts on the advice provided. Option C. Proceed with the M&A advisory services, assuming the client is aware of the firm's various business lines and their potential implications. Option D. Rely on the research department's report and the trading desk's position as indicators of the target company's value, without further explicit disclosure to the client. The correct answer is B. Ensure full disclosure of all potential conflicts of interest to the client being advised, and implement internal procedures to mitigate the impact of these conflicts on the advice provided. Explanation. This scenario presents a professional challenge due to the inherent conflicts of interest and the need to ensure fair treatment of all parties involved in a merger or acquisition. The principal's responsibility extends beyond mere transaction facilitation to upholding regulatory integrity and investor protection. Careful judgment is required to navigate the complex web of disclosures, potential conflicts, and the fiduciary duties owed to clients. The correct approach involves a principal proactively identifying and addressing potential conflicts of interest arising from the firm's advisory role in an M&A transaction. This includes ensuring that all material information is disclosed to all parties, particularly the client being advised, and that the firm's compensation structure does not incentivize actions detrimental to the client's best interests. Regulatory frameworks, such as those enforced by FINRA, mandate that member firms and their associated persons act in the best interests of their customers and avoid conflicts of interest. This approach aligns with the principles of fair dealing and the duty of care owed to clients, ensuring that advice provided is objective and that all parties are treated equitably. An incorrect approach would be to proceed with the transaction without fully disclosing the potential conflict arising from the investment banking division's prior involvement with the target company. This failure to disclose material information to the client being advised is a direct violation of disclosure requirements and the duty of fair dealing. It creates an environment where the client cannot make fully informed decisions, potentially leading to detrimental outcomes. Another incorrect approach would be to prioritize the firm's compensation over the client's best interests by structuring the deal in a way that maximizes fees, even if it means recommending a less favorable outcome for the client. This demonstrates a failure to act in the client's best interest and a disregard for the ethical obligations of a principal. Such actions can lead to regulatory sanctions and reputational damage. Finally, an incorrect approach would be to assume that the client's awareness of the investment banking division's prior relationship is sufficient, without actively ensuring that the conflict is managed and mitigated through clear communication and appropriate safeguards. This passive stance fails to meet the proactive obligations of a principal to identify, disclose, and manage conflicts of interest effectively. The professional decision-making process for similar situations should involve a rigorous conflict of interest analysis. Principals must establish clear policies and procedures for identifying and managing conflicts. This includes mandatory disclosure of all material conflicts to clients, ensuring that advice is objective, and that compensation structures do not create undue pressure to act against client interests. Regular training for associated persons on ethical conduct and regulatory requirements is also crucial.